Disney bet its future on streaming. Within a few years, the losses reached billions of dollars. The company gained millions of subscribers and still lost money. Despite massive growth, the streaming division reported multi-billion-dollar losses. This wasn't supposed to happen. Another major media company pushed aggressively into streaming. Its finances deteriorated soon after. More platforms launched, more shows were produced, more people were watching. But media companies kept getting weaker. And what is happening? If streaming is bigger than ever, why does the industry suddenly look unstable? In November 2023, Bob Iger, CEO of Disney, said, "The streaming business has been a drag on earnings, and our goal is to make it profitable." That's a strange thing to hear from the company investing the most in streaming. Subscriptions kept growing, but media stocks stopped growing. Some moved sideways, some began falling. Big announcements, small reactions. Something wasn't matching, the report looked strong. Revenue increased, subscriber numbers rose, and yet, the stock dropped. Good news appeared, market value disappeared. Companies spent more money on content. Budgets increased, production accelerated, more releases, bigger projects, more marketing. And it wasn't just one company. Similar signals kept appearing. Different companies, same direction. At that point, a different question appeared. Maybe the problem isn't one company, maybe it's what streaming turns media into. Up to this point, it looked like a management mistake. But it wasn't a management mistake. It was structural. Streaming is not a media business. It is an infrastructure service. Streaming feels like a product. You pay monthly and watch movies. That feels like buying entertainment. But you are not buying a movie. You are buying access. You are buying the ability to press play anytime. Access behaves like infrastructure. Electricity is available even when unused. The internet is available even when nobody is browsing. Streaming must be available even when nobody is watching. The system cannot sleep. The service must always be ready. Even when a viewer does nothing, the platform still runs. Servers remain active. Files remain stored. Data keeps moving across networks. Recommendations keep processing information. Costs exist before demand exists. In traditional media, a movie generated revenue once. The opening weekend mattered most. After tickets were sold, profit became clear. In streaming, content has a different role. Content prevents cancellation. Its purpose is retention. The show is not the product anymore. The service is the product. A subscriber can cancel instantly. There is no inventory. There is no delay. Revenue disappears immediately. Attention controls revenue. That creates pressure. If new shows slow down, cancellations increase. If cancellations increase, revenue drops immediately. The platform cannot pause production. It must constantly supply content. And here is the real problem. Growth does not reduce cost in streaming. Growth increases cost. More viewers require more servers. More servers require more storage. More storage requires more maintenance. More viewing requires more bandwidth. More bandwidth increases delivery expenses. And to keep subscribers, platforms must release new content continuously, which increases production spending. Here is the paradox. Success increases usage. Usage increases cost. Cost requires more content. Content requires more spending. Growth does not guarantee profit. It can create pressure. When streaming first appeared, it felt revolutionary. You could watch anything at any time. There were no schedules. There was no waiting for a broadcast. A single monthly payment unlocked a huge library. Compared with cable, it felt simple. Compared with theaters, it felt immediate. For viewers, it felt like the future had arrived. Companies watched Netflix expand quickly. Subscriber counts kept rising every year. Investors rewarded growth with higher stock prices. The conclusion looked obvious. Streaming was the next television platform. Every major studio launched its own service. Each company expected scale to create profit. But viewers did not behave as expected. When one service existed, people stayed subscribed. When many services existed, people rotated between them. Viewers subscribed for one show, they watched it quickly, then they cancelled. They returned when another show appeared. A new pattern formed. Subscribe, watch, cancel, wait, return later. The subscription stopped behaving like a membership. It behaved like a rental. Loyalty weakened. Attention became temporary. Companies expected subscriber numbers to always rise. Instead, cancellations appeared. Growth slowed. Retention became the real competition. Platforms reacted. Prices increased. Advertisements returned. Password sharing ended. These decisions looked sudden, but they followed a clear logic. Companies were no longer chasing maximum users. They were chasing reliable users. Streaming was supposed to replace cable bundles. Instead, bundles returned in another form. One show lived on one platform. Another show lived somewhere else. Households needed multiple subscriptions. Monthly costs started rising again. The experience began to resemble cable television. Viewers wanted flexibility and low cost. Companies needed stability and predictable revenue. Those expectations conflicted. The pattern kept repeating. The industry kept growing, but stability did not follow growth. At the beginning, something felt wrong. Streaming was growing, but the companies behind it were weakening. The numbers increased, yet confidence decreased. Now the pattern makes sense. The industry did not misunderstand technology. It misunderstood the business model. Traditional media sold products. Streaming operates a platform. A product can succeed once. A platform must succeed every day. Films created occasional revenue. Platforms require continuous operation. The service never stops running. Availability becomes the promise. The promise creates expectation. Because streaming behaves like infrastructure, success changes cost. Success brings viewers. Viewers bring usage. Usage brings expense. More viewers require more servers. More servers require more storage. More storage requires maintenance. The platform grows heavier as it grows larger. To survive, companies adjusted. Prices increased. Advertising returned. Bundles appeared again. These were not reversals. They were corrections. Streaming did not disappear. It stabilized. Viewers may switch services, but they rarely leave streaming entirely. Watching on demand has become normal behavior. It is no longer a novelty. It is a habit. We expected streaming to replace television. Instead, it rebuilt television in a new form. The industry did not collapse. It adjusted. The real change was never technology. It was behavior.